Can you guys see my presentation?
Yes, it reads lead, learn.
Yes. Okay. So this is just a crash course on non-QM lending. Vilma kind of already attended this course yesterday, but I'm just going to go over this now as a loan officer. Okay. So of course, I'm just going to skip the first 2 pages because this was originally created for her. Now, bank statement loans. How many of us on here are familiar with bank statement loans? Since I hear nothing, then I'm going to assume that none of us are. Okay, so bank statement loans typically, I would categorize them as 3 different types, okay? There's always going to be a 24-month, a 12-month, a 3-month with a profit and loss. Now, just like any file, you know, the more income we can provide them, the more secure the loan's going to be and the better the pricing is going to be. So if we can provide 24 months worth of bank statements versus a 12-month bank statement, you're going to get slightly better pricing. From what I've seen, it's typically about 1/8% on your rate. Majority of the loans for non-QM, any loan level adjustments directly affect the rate. You can always buy it down by adding discount points, but it always builds directly into the rate, okay? So 24-month bank statements, they can be commingled. If a client is doing 12 months of their personal, 12 months of a business bank statement, totaling 24 months, and I'm going to explain to you why I've seen scenarios like that, okay? A client might have been doing a small business and been depositing all of his earnings into his own personal account. Then somebody probably advised them and said, hey, why don't you create your own business account? And at the end of the first 12 months where he's been depositing into his own personal account, he's created a business bank account and then has been depositing from there, okay? Now, there's also commingling of personal and business, even though if it's 24 months, because what I've seen recently on one account, they were a plumber and they had their business bank statements. They were depositing money into their business banks, but they were also receiving Zells, I believe, for side jobs into their personal bank, right? The one thing that I want to tell you I've seen is we were requested to try to use full deposits on both, and you're unable to do that because you can see transfers from the business account into their personal, basically paying himself out from his business account, right? I can't double dip on money that they've already deposited into their accounts. Does that make sense?
Yes, it does.
Okay, so 12 months business bank statements and a 3-month bank statement with profit and loss is basically going to be considered the same thing, okay? The profit and loss on it basically needs to come from a CPA. If you guys are trying to use a lower expense factor, okay, what an expense factor is, how much of the income you're bringing in is actually used to maintain the business. I'm going to give you an example. If you are a retailer of some sort, right? A lot of people are in business doing small little things. Some people are conducting business by buying and selling shoes, for an example, right? Buying Jordans, they're collectibles, okay? Certain people are paying a pretty penny for those shoes, but the cost of doing business, you have to originally buy those shoes. So typically when somebody is questioning the expense factor, most likely when they're calculating your bank statements, they're going to give you a 50% expense factor ratio, okay? Because of the cost of goods. Now, if you're a... upload everything minus the assets and then I guess go from there, you know? I'm sorry, I'm hearing chatter, so I'm not sure if that's a question for me or... Okay, so for instance, if you're going to do a construction worker, a lot of construction workers that I know, used to buy a lot of the materials beforehand and then get reimbursed by the client. A lot of my friends have now gone into asking the clients to buy the cost of them or pay for the materials and buy the materials, and they're just coming to do the installation or the labor, right? So if that's your business model, what is going to be your expense factor? Since you're not dishing out any money really for the cost of materials, your expense factor might just be for the gas, you know, travel time, stuff like that, where it might be a 15% expense factor, right? Your car payment, insurance, those liabilities, okay? So depending on what it is, if the lower the expense factor, you better give me a good explanation on why you're wanting to use a lower expense factor. Because if you're telling me, hey, I want to use a 10% expense factor, which is the lowest I've seen for an expense factor, you better tell me that your profits way exceed your cost of running your business, okay? If all you're doing is paying for gas and your car, and that might be $500 a month, right? And you're bringing in $10,000 in deposits, then yeah, I can probably see a 10% expense factor, okay? But if you're paying for multiple vehicles, you're paying for a location business, that your expense factor is not going to be 10%. Okay, any questions on this slide? Okay, going to move on to the next slide. Bank statement guidelines. Self-employed bank statement programs are available for self-employed borrowers only. Okay, so is it only accepting self-employed borrowers? No. So what I'm trying to say is, if you have a client that works a 9 to 5, okay, and I'm going to use that shoe reseller as an example. Works a 9 to 5, they are W-2, okay, and they also have that side hustle selling those shoes on the side. It would still be considered a bank statement loan if you're trying to use those incomes from his side business, okay, because you're using W-2 to boost that income along with the deposits. They're just basically going to price you out as if it was a full bank statement loan, okay? When wage income is combined with self-employment bank statements, a tax return is not required for the full income documentation because it's validated by the bank statements, okay? So are we going to really run transcripts on them on that side? They probably are not, but they are going to want the W-2s to show that they have W-2 income. Does that make sense? No questions. I am going to move on to the next slide. So bank statement guidelines, okay? They are not going to allow non-occupant co-borrowers. Now, are there exceptions that might be that you can possibly request? Yes. Are they always granted? No, right? Because they want to make sure, since this is a risky loan, they need to, whoever is on the loan is going to be living in that property, because they want to make sure you guys are, the borrowers are concerned about making their mortgage payments and making them on time, for in layman's terms, okay? Now, the minimum FICOs for bank statements are 600 minimal, okay? And just like credit qualifying on any other loan, you know, their FICO is going to change their interest rate. The lower the FICO, the higher the rate's going to be, okay? Their maximum DTI is going to be a 50%. Be careful with that, because sometimes we can ask for exceptions, but we have to have strong compensating factors when we're asking for exceptions on the non-QM side. Okay, they are allowing 55% on full docs only, and with an 80% LTV, and require 6 months of reserves and minimum FICO of 660. Okay, 90% LTVs are available for borrowers with 720 FICO or above. So are we able to get them higher LTVs on these loans? Yes, but you need to come with a strong credit qualifying borrower in order to get that. Now, just a reminder, again, everything, all the LLPAs that are built into these strictly affect your interest rate, okay? Again, if you're gonna probably go with a 90% 720 FICO borrower, you might be seeing 9 to 10% interest rates right now, okay? Where if you go with an 80%, you might be seeing middle 7s to 8%. Do you guys have any questions on that? Okay, so within these guidelines also, you know, if a bank statement loan doesn't work for you guys and we have 1099 loans, they are available as well. With 1099 loans, we're not looking at the bank statements. You just got to provide the 1099s. And the maximum LTV on those are going to be 80%. Most of the time, of course, it's going to be how you want to document the income. A 1099 program might work a little bit better if they have pretty high expense factor ratios. And you know, the 1099s are going to be for our contract workers, right? If you have a truck driver that is getting 1099, but he might be spending a lot on diesel or something like that, the 1099 might be better because his expense factor might be really high because he's taking lower bids on driving some of these truckloads. That could be a reason why you might want to go 1099 only, because you'll see that there's a lot of expenses going out and your expense factor might be higher if he's taking lower bids. But if you want to eliminate the expense factor, the 1099 program might be the best way to go. Do you guys have any questions on that? Okay, one more thing about expense factors. If your borrower has multiple employees, they're going to be using higher expense factors, right? Most of us know the cost of doing business becomes higher as we have more employees. So if you're in the service business, this is an example here. If you're doing a 0 to 1 employee in the service industry, you will only, they're looking at maybe about a 20% expense factor. But if you have a 2 to 10, they're looking to use 40%. 10 or above, they're looking to use 60%. Okay. The reason being is you guys already know with additional labor comes salaries, right? So you can still fight to get this lower, but this is just basically the simple calculations that they're pretty much going to go based off of initially, okay? Product business, kind of like what I was explaining. If you're doing jewelry, construction, food, manufacturing, retail, you know, collectible selling, you have to buy product. So it's going to be the same thing. They're going to be using higher expenses as you have to document more employees. So most of us, if we're doing bank statement loans, it's most likely for a small business. You might have 1 employee. If, you know, the individual is a gardener, right? Usually they travel in 2s when they're working out there. So, you know, we need to be cognizant of how many employees are there before we're trying to fight the expense factors, okay? Because when we're trying to fight what is the norm, you're going to have to give me very good reasons on why we're trying to use a lower expense factor. So if it starts going too low, what they're typically going to ask is, hey, can you give me an expense factor from the CPA, right? They want a third party if we're going too low to verify that their expense factor is that low. Because if we don't get a third party review of it, they're just going to think that you're manipulating the income. Does anybody have any questions about that? Okay. Now on to the self-employment section of what they're considering self-employed borrowers. Self-employed borrowers, a borrower with 25% or greater ownership interest in a business, is considered self-employed and must be evaluated as a self-employed borrower. Okay, so can we do bank statement loans using business bank statements for an individual if they are 25% ownership? Yes, we can. So basically what they'll do is they'll take the bank statements, calculate the income, and give them a quarter of the percentage of that. Okay, so basically the percentage of ownership is very important, and they're going to ask you for documentation on the corporation to show what's the percentage of ownership when they know that it's multiple owners. We've done at my previous company a lot of loans for companies that had 2 or more owners, and we just gave them the income based off of the ownership percentage. Okay, 1099 contractors basically don't want to see Schedule C or Schedule E with the IRS tax returns, and they'll probably be requesting 1099 only confirmation from the IRS. That's why it is a little bit more difficult doing the 1099 loans, but sometimes, like I was mentioning, if you're getting a high expense factor ratio, going 1099 might be best. It's just going to be a little more troublesome on trying to deal with the income documentation. Okay, now service and tip industry, you see there, due to the cash nature of the service and tip industry, those borrowers may participate in the bank statement program. Full document is required for employment. So what they're going to do is they're going to get their base salary, right? Here in California, I believe servers make minimum wage plus tips. Okay, not the rest of the country is not paid that same exact way. I think when I was younger, I was working as a server, and I think my hourly wage was $2.15. Okay, so they're going to ask to just try to validate the base salary, and then they'll be looking at the deposits you're making into your bank. Hopefully they're depositing their money and not just keeping everything in cash, right? But this is how we're going to be looking at their bank statements, okay? One example I gave yesterday during the presentation, which I'm going to go to showing how income's calculated based off of the bank statements, is if you have somebody who receives a lot of Zelle, okay, just make sure that we're going to give them a narrative on why they're receiving so many Zelles, because, you know, a lot of us might have gone out to lunch or dinner recently with friends and somebody paid for it and you're going to Zelle them money. If I receive a Zelle because we went out to dinner from my friends, that's not going to be considered income, right? So just remember, on bank statement loans, if they back out any deposits, you guys can always fight it, but you need to give us reasons why to add it back in. So for instance, if I occasionally might get a Zelle from a friend because we went out to dinner for $100, am I going to be able to use that as income? No. So they're probably going to be backing out those Zelles. So just make sure that if you see consistent Zelles, we let them know why. I was using that example earlier where a client might be doing side work or receiving, you know, direct payments from individuals via Zelle. What might be asked is start providing invoices, right? So just remember, everything in here just needs to be documented. If we're going to try to fight anything, it needs to be documented. Recently, we had a bank statement calculation where somebody said, hey, is it going to be okay? Because my client just got a $75,000 deposit. Well, yeah, that's okay. They're going to question why you have a $75,000 deposit. So get me an invoice so we can provide it to the underwriter so they can see why we have a $75,000 deposit. Okay, so the next slide is going to show you how bank statements are usually calculated. In this example here, right, you see the deposits are highlighted at just a little bit over $30,000. My next example shows a deposit that's highlighted under there, but it's a purchase return. So am I going to be able to use that purchase return of $66.40 towards my total income deposits? No. Okay. But I have a deposit here for over $3,000 and another deposit down here for over $3,000 or $1,000, right? Am I going to be able to use that as income? Yes. So they're going to be evaluating everything that's going to be in your deposit column to see what they can use and what they have to back out. Okay. Online transfers. Okay. If the example I gave earlier, the client had a business account and a personal account. If the online transfer to their personal account, which we were trying to use deposits from that as well because they were receiving all their Zells on there, was coming from their personal business account, I can't double that deposit. So, but if this is one account, let's say it was their business account showing here, and I'm getting a deposit from another business, I'm going to be able to use that. Okay. As you see here, that this business deposit here was $3,000, and then there was a $1,200 deposit up there, but it just says deposit. They're not going to question using that amount. Okay. Any questions on that so far? So we all understand what type of deposits we're going to probably going to exclude, what we're going to use, and what we might want to fight. Correct?
Correct.
Okay. So now the self-employed 3-month bank statement program. Okay, this is where, you know, I wanted to make sure you guys understand this, because a 3-month bank statement program with the profit and loss can sometimes be very, very helpful, but sometimes it can be detrimental. Okay, I just want to have you guys understand why it can be detrimental. During COVID, if you were a retail business, okay, at certain points of time, the smaller stores had to close down, right? So you might have had a 3-month period where you're showing yourself not very profitable, right? And then you show, let's say, 9 months of being profitable on bank statements, okay? And the profit might be extremely high, okay? They don't count the expenses against you. So if you went with a 12-month bank statement loan, the average calculation might give you, let's say, $15,000 in income. But if I do a 3-month bank statement with a profit and loss, remember the profit and loss also includes your rents. So during the period where you weren't earning money, right, the rental of that location is still hitting your profit and loss. So that's showing expenses that you're dishing out versus your profit. So do you think that your income doing a 3-month bank statement with a profit and loss is going to be higher or lower than if you went with a 12-month bank statement? Anybody? It would probably be a lot lower, right? Because if you had 3 months of not being able to do business, and let's say your rents for that location was, I'm just going to throw out there a number of $3,000, okay? You're already at a $9,000 loss on that profit and loss statement because of those 3 months that you were not operating. But if I'm doing a business bank statement, right, I can argue my expense factor and say that it's a little bit lower, and I can possibly get higher income by going with a 12-month bank statement. Does that make sense?
Yes.
Okay, so is a 3-month profit and loss, and 3-month bank statement and profit and loss good? It can be good, but that's where you want to kind of evaluate everything, right? When you guys are structuring this, if they have a CPA, I would probably suggest go this route and see what it looks like. Okay, because if the CPA is already employed, they don't mind putting together a profit and loss, because if I'm dealing with my CPA, right, they're continuously looking at my books and can prepare a profit and loss for me. But if you're doing this and taking a look and you're seeing that the income would be a lot less, I would probably suggest going with a 12-month bank statement with a decent expense factor letter. Okay. Do you guys have any questions on this slide?
Nope.
All right. So one thing that, you know, a lot of people will not discuss with you guys typically on bank statement loans are NSFs, non-sufficient funds, right? I teased, I'm sorry? Okay. I teased a little bit yesterday. You know, we've all been teenagers, we've been young adults, right? At some point in our life, I'm pretty sure everybody here has had an NSF on their account, okay? I know most young adults are not very savvy with their money and might have one or two NSFs occasionally here and there. Businesses can happen a lot, right? Sometimes our invoices come in and we don't have sufficient funds, but we still write the check, and before we get paid from an invoice that we have outstanding, we get hit with an NSF, okay? So NSFs are something that they're going to be looking at, okay? Now, typically they're okay with up to 5 NSFs within a recent 12 months. Anything more than that, they're gonna start questioning and evaluating it, okay? Because if it's once or twice, they'll just probably ask you for an LOE, hey, what happened here? Because, eventually your account becomes positive, so they'll see that. It's just, they wanna know that these clients are gonna be okay. They're not mismanaging their money too much, right? Because if you're in business and you mismanage your money, what's gonna happen? You're gonna go out of business. So, I was mentioning to everybody yesterday that non-QM loans are a lot like our subprime loans. The only difference is it's highly regulated and everything is going to be double checked. If you give me bank statements, they're going to do VODs. They're going to make sure that those bank statements are legit, from deposits to ending balances. So, I'm hoping that I never see anybody, come back and say, hey, these don't add up, this is fraudulent, right? None of us would ever do that. So I'm just going to tell you, be very careful, because the clients, some of them are out there pretty savvy, thinking that, hey, let me fluff this and nobody's going to check it, but they're going to check it. So I'm going to tell you, be very careful, because VODs are a check and balance for bank statement loans, just like VOEs. If you do VOE only programs, you better believe they're going to call and check with that employer. They're not going to accept any, verifications from, the originator. They want to do it themselves. There's checks and balances that they have to make sure are happening to make sure these loans are going to be serviceable, right? So if you happen to have more than 5 NSFs, they're going to most likely ask you for LOEs, and hopefully you don't have anything pretty current. If you had 5 in the last 12, but the last one was 6 months ago, right? They're going to probably see a good trend there, and that might be an exception, because let's say you hit 6 or something like that, okay? Any questions about NSFs?
Nope.
Okay. This is not a commonly used source of income documentation. Asset depreciation is a type of income that we can possibly use if the borrower or client has a large amount of assets sitting somewhere. For instance, I'm going to give you examples of somebody who's retired. Let's say somebody who is retired has assets totaling, liquid assets, okay, totaling about $10 million, and it's not working. Assets can be used to calculate income, and how they're going to do that is they're going to see how long that money stretches for approximately 15 years. Okay, so if you're using $10 million stretched approximately 15 years, right, how much is that in a month? They're assuming this because they're using 15-year average, because of course, hopefully you're earning a rate of return on your assets, but they just want to make sure that within the next 15 years, your assets can cover this. So they're going to take that amount. This example is $10 million. They're going to take that $10 million, divide it by 12 months for 15 years, right? Or 15 years for 12 months. And whatever that monthly income is, they're going to be using that as the income, okay? Does that mean that you can possibly be making very good income? Yes. So the higher the assets, the more the income, okay? This also works for inheritances. Your parents might have passed away, they left you a lot of money, you decide you no longer want to work, or you want to supplement income using the asset depreciation, you can. So how likely are you going to be using this for your everyday client? Probably not, but I wanted to make sure you guys know that this product is available in case you come across somebody who's not working, maybe somebody who just hit the lottery and wanted to purchase a home, right? They have a large sum of money, they're not working. How are we going to calculate their income? The type of loan that you're going to be looking for is going to be an asset depreciation. Do you guys have any questions about that? Nope. Okay, on to the next slide. So I do want to go over some other niche products, right? The 1099, I kind of already went over that with you guys, but non-QM loans also offer VOE only programs, okay? The VOE only program do have limitations, maximum LTV limitations, right? The maximum LTV is going to be 70%, okay? Minimum FICO is going to be 620. Now, I'm telling you this because this is a product that is offered, but if you're going to try to go with somebody that has a VOE only program, I would probably suggest what's called a no ratio program, okay? No ratio programs basically just ask you for employment. They're just going to confirm that they are employed, okay? They're not going to calculate income from that. So these loans are a little bit harder to close, but you can have a higher LTV. So look at the section down there where it says no ratio. So the 80% LTV is available for a client who has a 700 plus FICO on a no ratio. If somebody has a 640 to 700, you can do a 65% LTV, right? So depending on your client, if they have a high FICO, I would probably go with a no ratio, allowing up to an 80% LTV versus a VOE only. I'm going to tell you now, most of our non-QM loans, you guys already know, we are brokering it out. These products are too volatile, and it's a lot easier for them to deal with everything on their end, underwriting, doing everything in-house, because it's easier for them to manage. Some of the companies that we do broker out to do securitize their own loans, so they can hold on and make exceptions on what we're offering. But all of the guidelines I'm giving you guys right now are just basically generic guidelines that are going across with everybody, okay? So with this no ratio program, their closing time is a minimal of 30 to 45 days right now, because there's a lot of verifications that they have to do internally and they will not use our verifications. So just letting you know, if you're going to try to get somebody into a no ratio program, make sure that the close of escrows, we're getting a minimal of 30 days, okay? Don't let the borrowers enter contracts less than 30 days if you're going to try to use the no ratio, okay? The no ratio programs do allow you to go with condos, but they're going to reduce the maximum LTV by 5%. So if you have a borrower who has a 700 plus FICO and they're trying to purchase a condo, your maximum LTV is going to be 75%. Do you guys have any questions about that? No? Okay, so I just wanted to show you guys on line 2 on the VOE program versus the no ratio. You see how the no ratio is saying a 65% LTV with a minimum FICO of 640. So if I have a client who's 640 to, let's say, about 700, the VOE only program might work better because you can go with a higher LTV of 70% on the VOE program. Does that make sense? Okay. ITINs. So a lot of you, there have been a lot of requests about ITINs, and just so you guys know, ITIN products are available, but they are scary to investors. And I want you guys to understand why, right? So I hate to say it this way, but ITIN borrowers are using an ITIN because they don't have an official social, right? So at any point in time, there's always a small chance that they might get into some type of trouble and no longer be in the country. So those loans are risky to them, okay? ITINs are coming back slowly because as the market gets bad, companies tend to restrict their programs. And as they see business starting to dwindle, they start expanding on their programs a bit again and relaxing on their guidelines. So right now, most lenders, when you're going to go and try to get an ITIN loan, you're going to probably see a requirement of 80% LTV. But what's going to happen is because the market right now is so slow, they're probably going to ease up on that and say, hey, let's try to generate more business. So to be honest with you, I think by the start of next year, you might see LTVs on ITINs back up to 90%. But at this point, majority of them are doing an 80% LTV because if something does happen to the client, God forbid, they have equity in here. So I just want to let you guys know, if I have somebody who's doing a 95% LTV ITIN and something happens to them, as you know, you guys probably seen the news, housing prices have been going down in certain areas almost by 5%, depending on the area, okay? So if I only had 5% down and I was in that area and their home prices have gone down by 5%, I'm now at 100% LTV, not really a 90% LTV anymore based off of the new value, right? So that's very risky for lenders because even if they have to foreclose or take the property back, there's no benefit for them anymore, right? God forbid that ever happens. As you guys can tell, I don't know if you've been paying attention, but foreclosure rates are starting to go back up again, right? So on the lending side, they're a little more cautious because the higher the LTV, the riskier the loan is on their side, okay? So I just want to go through their guidelines. So typically they want 2 trade lines open for 12 or more months with activity, okay? Some of them do have guidelines now with it. It's 1 trade line of their own open for 12 months or more, but you need 2 other self-reported credits. What that is basically, we all have a cell phone bill. We all might have a condo, insurance. You can self-report those to the credit bureaus and have that added onto your trade lines, okay? So they're gonna want, if you're gonna go with 1 trade line, they're gonna want 1 trade line with 12 or more months of activity and minimal of 2 self-reported trade lines, okay? LTVs are going up to 80% on these single family residents, 80%, condos is 75%, and they're looking for a minimum of 6 months reserves. And when I'm saying reserves, it's the PITIA, principal, interest, taxes, and insurance, and any assessments, okay? So if there's HOAs on a condo, that needs to be added in there. So just make sure that we have minimal of 6 months reserves there, okay? DTI cannot exceed 43%. I'm sure there are companies slowly releasing updates. So if you guys have ITINs, just let us know. I'll reach out and see if there's any updates to help fit your loan. But if your ITIN loan's fitting this, pretty much any company that's going to be accepting ITINs will take these specific overlays or guidelines right now. Mobile homes on ITINs, that's where it's going to get tough. We recently had one. There is one company that was doing it, but that was almost a 45-day closeout. Because there was a lot of extra documentation there. That mobile home was a little more difficult because it was the HUD requirements for mobile homes. So we had to get a rebuild letter from the county. That it was a little more hardworking, but yes, we have one outlet that we found that will do mobile homes with an ITIN. Any other questions about this before I move on? Okay. The last slide, the benefits of non-QM, okay, and credit eligibility. A lot of people might not know this, but non-QM will allow loans 1 day out of forbearance, 1 day out of foreclosure, 1 day out of bankruptcy, and up to a 90-day late on mortgages and trades, okay? We already know Fannie and Freddie, FHA, VA will not allow these. So if you have a client that went through any of these credit events, does that necessarily mean that they are eliminated from purchasing a home? No. I would look into the non-QM side. What's gonna I hate to say this, what's gonna happen is their rates are gonna be high because this is a riskier loan. And are they gonna probably require more of an LTV, a lower LTV? Probably, but I wouldn't eliminate clients who have these credit events from purchasing a home again or refinancing their home just because they had these events. You would want to look into non-QM because this is one of the beautiful things about this product is somebody might have filed bankruptcy, but they're ready to buy another home because they were able to keep a decent amount of the assets. They can go buy a home, but the rate's going to be high, right? Do you guys have any questions so far about any of the non-QM loans? Did you guys want me to touch base on DSCRs?
Yeah, that'd be great, actually.
Okay, so DSCR loans. So they stand for debt service cover ratios, okay? The number one thing that you want to try to take a look at is what the market rents are, okay? If you know the market rents, let's say, I'm going to use Orange County as an example. If you're doing a 3-bedroom, 2-bath home as a rental out here, you might be looking at $3,500, okay? If the borrower is buying a home or doing a refinance and your PITIA is less than that $3,500 or exactly $3,500, you can debt service cover ratio, right? You can use DSCR, okay? They're gonna be looking for a 1-to-1 ratio. If you can get your rents to cover your payments, you're okay. So typically the easiest way is if you're having a client doing a purchase, okay? The appraisal, I would request a 1007 to get the average rents in the area because the average rents is going to tell you what I need to try to get the payments to make it work. Now, there's several ways to make that type of payment work, okay? If the specific lender that you're going to go to offers an interest-only payment, right? So most of them will offer a 30-year with a 10-year interest only. Okay, if your interest only period of 10 years payment covers the rents that you're receiving or the rents cover that payment, you're going to be okay. They're not going to qualify you on the fully amortized like they would normally do on the DSCR loans only. Okay, if you're doing an owner op, they're going to qualify the borrower on the fully amortized payment. Okay, but there's interest only options. There's ARM options. So you're going to want to look at the different ways that we can structure the payment to make sure that you're at least a 1-to-1 ratio. Okay, so is there a way to get past a 1007? Let's say the 1007 comes back with the rents at 3,500 and you know that you can rent the property out for 3,600 or 3,700. If you can find a client early enough and get a lease agreement, we can use that to argue because the market rent is lower, but the property might be somewhere desirable in a nice quiet neighborhood or something like that where you think you can get a little bit more and you can get a lease agreement and they're going to ask for the lease agreement and probably the deposit from the client. It might not have to be deposited yet because the client does not have ownership of the property yet, but they're probably going to ask for a deposit, copy of the deposit. It can be PTF or something like that. I've seen it move PTF because if they know the transaction's going through, they can deposit the basically the deposit from the client borrower or sorry tenant and use that to clear that condition, right? So can you fight market rents on those when you have 1007s? Yes, but you better come up with some good lease agreements and start sourcing the first month's deposit typically that you would take with a lease agreement. Okay, so does DSCRs work? Most of the time, it's probably going to work best right now for clients you might have out of states, okay? The cool thing about it is I have originators on here who are licensed in only certain states. I believe most of you guys are licensed in California. The cool thing about DSCRs is they're considered commercial loans. So most of the companies that we broker to, if you're doing a DSCR, as long as they are licensed in that state, because it's considered a commercial loan, you can still originate that DSCR in that state. So are you going to be required to be licensed in that state? No. I'm going to give you an example. If Abby here has a client that is moving to Texas, for instance, and the client is trying to buy a DSCR property, we can get them to debt service cover and everything like that. Abby can be the originator on it because it's considered a commercial loan. So she can be on the 1003, right? Typically, most of us know we cannot originate a loan in a state that we are not licensed in. But if it's a DSCR product, most of the DSCR lenders are allowing you to originate in states that you are not licensed in as long as they are licensed in that state. So if you have clients that are looking to buy properties out of state, does that eliminating you from helping them? No, as long as it's an investment property and you can get them to debt service cover ratio, DSCR. Do you guys have any questions about that? Since there's no questions, can somebody ask me, what do you have to cover in payment to DSCR?
What do you have to cover in payment for DSCR?
Yes. So if you're getting $3,500 in rents, how much can your payment be for the client on the loan?
At least a 35 or 36?
Correct. I just wanted to make sure you guys are getting it because we're here, of course, to help you. But in order for you guys, to understand these products, I want to kind of be a little more interactive with you guys. And I'm pretty sure a lot of these trainings haven't been very interactive. So if you have a client that gives you a rental agreement because they're trying to do a cash out, their rent is $3,700 and your payment is $3,600, do you guys debt service cover ratio? I'm going to repeat it again. If you're collecting rents from the tenant of $3,700 and your PITIA is $3,600, do you debt service cover?
I want to say yes.
That is correct. Okay. So is it profitable or is it beneficial for some of these clients? Yes. Right. Because the one thing that you want them to understand is even though the rates might be higher, but if you get them to DSCR based off of those rents, did the client lose any money? No. So
No.
if you give them a 10% interest rate on a DSCR, but they completely cover that property on their rents, every payment that's being collected on that rent can go through that mortgage payment and they're earning equity every single time they're making that payment. So is it beneficial for the client? Yes. So that's one thing that I want you guys to help them understand is how beneficial it is for them, right? Because a lot of clients, you guys are out there every day, a lot of them are just struck and hung up on the interest rates. But does the interest rate really matter if they're earning equity every single time they're collecting the rent payments?
No.
Right? So help them understand that because if they're doing investment properties, this is an easy close, very quick close, as long as you guys can get them to see the benefits to it, okay? So that's why I want you guys to understand that program, how the payments work, how you calculate it. If they debt service cover ratio, is it beneficial to them? Okay, that last scenario where they're collecting rents at $3,700 and their mortgage payment's only $3,600, that's very beneficial. Does it really matter what rate if they got a 10% interest rate where they're still walking away with an extra $100? No.
That's right. Yeah.
Okay.
Oh, they're not.
So when you're selling DSCRs, I wouldn't just sell them rates, show them the benefits, right? Payment versus what they're collecting in rent. Do you guys have any other questions?
No, we're good.
No, we're
Thank you.
good.
Okay. So if you guys have any questions, please feel free to reach out to me. If you guys just want a copy of this presentation, just as a reminder, just send me an email and I'll forward it over to you because I'm not.
Follow up the slate.
Yes. Yes.
Okay, so if there's no more questions, I'm gonna thank everybody for attending and we're gonna stop this here.
Thank you, David.
Thank you, David.
Again, if you
Can
guys
we
want-
get the
Very much.
slides as well?
if you want the slides, just email me, okay?
Will do.
Okay, thank you guys. Bye.
Thank you. Bye.